All right, so the week started with news from China about Evergrande maybe being purchased, with their shares being halted. There's also some chatter about trade-related issues and saber rattling between China and Taiwan. So the meter was going up big time. You also have the debt ceiling also being a topic of discussion today. Here in the U.S., supply chain issues, energy supply, with prices of energy going up. Anything that you could be worried about was brought up today, and add on top of all of that, the whistleblower for Facebook coming out over the weekend, and an outage of all of its websites throughout most of today, which kept me from being able to talk to my son today, because that's what we use to talk to him over there in Nebraska. As Facebook while he's serving his mission there. So all of that contributed to a little bit of a falling out of the bed for the markets today. So I'm going to break down just how bearish it was and whether it was enough to like set the low, and the bottom is in, and here we go. There's been a lot of that kind of chatter out in the media today. So we're going to talk about that and what the charts tell us. And we're going to take a look at, then what do we expect? If this is a low or if it's not, what do we expect to see? Not just hope to see. And then we'll also talk about what's driving the action from an asset class standpoint today, as well as our trade idea will be very similar to what we saw on Friday. A really good opportunity on the stock that's kind of sold, that in and of itself has had a pretty decent sell-off. And what can we do about that one? So let's go ahead and get started. Today is Monday, October the 4th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. And you can see the S&P now is down over 3 1/3% below the 30-day moving average. The farthest it's been for a while, right? This line here marks a 2.5% mark. You can see we got down to 3.5% there at that Halloween low point, and that started the rally. A couple little pullbacks, small little, again, near-term declines that really never were intermediate declines on the S&P. But the intermediate line here has fallen all the way down into the lower reversal zone now. That's the first time, again, that's happened for quite a while. Again, we haven't had that since back here in that September-October timeframe. Again, remember we got the Halloween low point that started the rally, but it was down here. It got down to the below the 12th percentile at that low point there in September of last year, and at that point too we were down almost 5% below the 30-day moving average. Of course, over here, in the COVID drop, it was a much different story. Short-term sentiment was dropping. You can see short-term sentiment is actually still rallying. Momentum line dropped, but the near-term line is still moving up higher in the neutral zone. Of course, if it turns back around and comes back in the bearish territory, that wouldn't necessarily be the most positive development. Continuing the bearishness that we've had. The one positive thing that there's kind of two things that happened with today's close. Number one, we finally closed below that low point. This is the first time we closed below 43.05. We got to 43.07 that day, and now we're at 4,300. So the first day we closed below that kind of significant low point there. So that's not a little bit bearish on one hand, but on the other hand, we didn't close below yesterday's low point, and so that's relatively positive, not as bearish as it could be, even though we are, down whatever percent. We're in the second percentile of how far we've been down in the past year below the moving average. Obviously, dark pink shading and a red line. Market sentiment's falling. I believe we're in the market sentiment pullback now, so I believe that will move back, eventually down to below the 40th percentile in the pink territory. That remains to be seen what ends up happening. Of course, watching the near-term lines rallies will give us a good indication of when we might be done, when the quote-unquote bottom will be in, whatever kind of bottom this ends up being. But as of right now, you can see that's not the case for the S&P 500. And you can see for the Dow Jones Industrial Average, also the momentum, the near-term line, intermediate line back into the into the bearish territory there, still well below the moving average. Near-term lines up into the neutral zone, but not any further. We're still, again, riding below, in this case, the 62% retracement of the last intermediate run it's been on. If you go back to this 23% line, we're still easily above that, right? And the same thing, for that matter, for the SPX. You notice we're still not breaking below that 4220, 4250 area, which is that 23% level off of that Halloween low point. If you look at the NASDAQ actually has fallen below that 23. So the NASDAQ is the first major index to retrace more than 23% of its post-Halloween low rally that we've had since last year. I mean, that's the big run we've been on. On the S&P, it's the move we've had without a 10% pullback. It's actually without a 5% pullback, where we got up almost 40% without one. So that's the run we've been on, and now you can see the NASDAQ. In fact, the NASDAQ's intermediate lines all the way down to the 5th percentile. Near-term lines in the neutral zone, but again, not flirting with strong enough levels. And the NASDAQ actually did close below its low point yesterday, and obviously already had closed below that low point. So very bearish. Of course, we are down more than 5%. This is obviously an intermediate decline, but the fact that it's below that 23% retracement level of this big long-term move is pretty significant. Now remember, it did get a pullback, so I took that line off to post on Twitter. But this is the actual intermediate run that it's on right now. I just keep the black line on because it coincides with what we're seeing on the S&P 500, so the same move there. But remember, we are down below the 38% retracement level now of its current intermediate run, which makes a run down to about 14,000 very likely for the NASDAQ, which is about another 500 points away roughly. So just kind of keep that in mind. That's where the 38% line is for the for that post-Halloween low run. So that would mean a 38% retracement. And now looking at the Russell 2000, you can see look at that thing coil. It has been coiling like hardly anything I've ever seen coil. It's just, let me get rid of this line. It's just really going sideways, not moving anywhere, one way or the other. Obviously, the intermediate line's pointed lower. Short-term sentiment's stronger than any of the other indexes, as a near-term line is still in the neutral zone, but at least at the top of it. Everything else is barely at the bottom of it. But still, you can see, again, it's like, which way are we going to break out of this coil? The more this thing coils, the more dangerous the next breakout move is, which is fine if it's to the upside, but not necessarily fine if it's to the downside. As we've talked about before, there's not very much support at all below this 23% retracement level. Because we've been so sideways, because that sideways range is so small over the past however many months, we can count them up there. That's a recipe for a breakout move. Ideally, if you're bullish in the long term, like most people are, like I would be too, the ideal is we'd break out to the upside. But the danger and the risk, which is why tail risk is so expensive right now, is because a lot of people are still worried about the big, not just a drop, but a big drop, a big breakout move to the downside, which for the Russell, you're looking for a move down to about 1,800 would be kind of a likely decline for the small cap index, considering again the lack of support that would halt that decline versus the much stronger support some of these other major large cap indexes would have. So that's what we're seeing right now on the market forecast chart. Of course, in looking at the new Hakinyashi candle for this week, it's again bearish, a bigger candle we've seen for a while. We're below the 10-week moving average. It's falling. We got the red arrow. We got the falling PPO now. Finally, really breaking down further than what we saw over here. We're not below the 200-day. We're not in fear of any kind of death cross currently. Pink shading across the board. Whoops, not on this one. It would be on this one. Pink shading across the board here, which means we have 3 red arrows everywhere now. Yesterday or Friday, we had the green arrow on the Russell, and we talked about how easy it would be to get back, and you're starting to get those kind of striped pink and clear, which happens a lot on bearish moves. So, this chart shows intermediate declines for all these major indexes. Not too surprising, right? Take a look at some of these other indexes. You can see, we're below 40, we're below minus 100, we're easily in the lower half for the SPX, and NASDAQ is even more bearish than that, even though we're kind of setting up some divergence there on the CCI. The Russell is not as bearish. It's still very neutral. It's right around the midpoint on both of those charts. Again, it is coiling as much as I've ever seen anything coil. I mean, even looking at its DMI, both those lines are dropping, and they're almost both below 20, which is insane, right? It's rare to get. I mean, it's one thing to get one of the lines below 20. It's pretty rare to get them both below 20. It takes a very extremely flat neutral trend to be able to do that. And you can see you can get the ADX down there with both lines up above, close to 25. You can get the ADX over here. You had both lines kind of crossing at 25, but here you got both lines between 25 but actually dropping, and pretty close to both dropping below 20. That's not the case for the other indexes, of course. The SPY, you've got the big breakout. The positive indicator index is as low as it's been. It's just as crazy for the Qs. We're getting an arrow, so we're below the 10th percentile, which is insane. Just to kind of give you an idea, you get the blue arrows over here in the COVID drop at the low of the COVID drop. So that kind of shows you this, the strength of the decline now with the ADX rising up above 30. We're not quite getting the spike above 40 in the negative, which is a little different than what we saw. It's kind of similar to what we saw over here in the fourth quarter of 2018, which means that we could very well get a rise back up, but that won't mean it will be over with, not like the COVID low point was. So something to keep an eye on there for the Qs. Let's take a look at trend strength indicators. Of course, we are now close to below -5. We're at minus 3.6. We are at 78, so we're almost above 80 there. So to the point where we've got strong bearish trends. We're obviously well below the cloud, or not well below, but we are breaking below the cloud. The NASDAQ is breaking below the cloud. It is now below -2, above 65. So we have both the S&P and the Qs in bearish trends, intermediate strength trends to the downside, and both below their clouds. IWM, remember, very noisy. I mean, look at that. Very, very noisy. Cannot get going. And the cloud's about as tight as it is, and it's not going one way or the other. Your diamonds is the strongest bearish trend out of all of them. I mean, well, it's been stronger for a while, and it's been below the cloud for a while. So it's interesting how your diamonds hasn't been as bearish in the last few days. Hasn't got a lot of the pub, but it has already been pretty bearish, relatively speaking. Remember, it's been on kind of its own intermediate decline here for a while, starting way back there in early September. We dropped below 40 there and had the dark pink shading and a red line, not quite below its 23% line like we mentioned before. Bollinger Bands, you see SPY still in the lower quartile, not really pushing against a lower band. If you take a look at that relative to the Keltner channels, you can see we did close right on the channel. We were a little bit below that. Remember, that's kind of the sweet spot for a trending move, is to be pushing against a lower band outside of the lower Keltner channels. The same thing on the upside, right? So we've got some strong bearish momentum here with green dots, which means we're in the right spot. We got a trend going here. The Qs, you notice we did we didn't break down below the band, but we are still below the Keltner channel. They're both falling. Again, that's bearish. That is as bearish as it can be. And of course, IWM, as I mentioned before, that sucker is so coiling. Even the bands now, the bandwidth is as low as it is, and it's getting tighter, and they're getting even, there's no momentum. We got red. They're well inside the Keltners. This, like I said, this thing is screaming for a breakout. Again, flip a coin as to which way it's going to go. Of course, considering the trend of everything else, you would anticipate, unless things change, it would be a breakout to the downside. Let's take a look at today's intraday chart. As I mentioned, it wasn't as bad because we didn't close below yesterday's low, which would also be last week's low. We did get a new 4-week low point that gives you this continuation of this bearish Arun indicator, right? Until it really breaks back down below the 70% level, you're not going to really have that low point set, and that's obviously not the case yet. We need to get it breaking down to really set that low point, and then get that green line to move higher. And we're just not to that level. We're not anywhere near a 4-week high anytime soon. The Qs are pretty darn bearish too, continuing to form new 4-week lows just about every day. And IWM, you can see it has broken below. The low has broken below the 70% level, but its green line hasn't broken up above 30 yet. So we're really not, again, that's about as coiling, and pretty rare for that to be the case. So another reflection of just how neutral and sideways and how prone to kind of craziness we might be getting here pretty soon in that index. Let's take a look at the volume today. Back at the 127 million, the range 7.6 points. Again, we don't have to worry about the gap. So 7.6 points, 127 million. Let's put those numbers into context here. 7.6 points is up here at the top. Again, that's bearish. 120 some odd million, also obviously off the charts too. So you can see, I mean, we're really heading higher. That's on the 1-year chart. Of course, if I go to the 2-year chart with the COVID moves, now we can kind of see the 7.6 points is right there. 120 some odd million is right there. So there, I mean, those are strong numbers, but not extreme numbers like we were getting over there. But pretty decently strong figures for your typical move. Now you notice, for us to get to a 2% move, like right now today, for us to be at 2%, the ATR needs to be at 8.5 points roughly. So we're nowhere near that. The ATR would have to get up to that point, which means we got a lot more of these kind of bigger size days to come. By the time we probably finish, if we get to 400, then that means the ATR has got to get to about 8, which again means more 8+ days of trading ranges. Again, to the upside and the downside. So don't forget, it's not just downside moves day after day after day. When you get these bigger moves to the downside, they're followed up with equal size moves to the upside. Today's wasn't as extreme, so it might not follow up as quickly. When you get these kind of 1% moves, they can kind of pile up on each other before you get the bigger 2% drops that typically sparks the big move. That's when we get the extension. When you extend away from the 8-day moving average, we never did look at this chart. When you extend away from that 8-day moving average, you can see, with a good strong move, you typically will come right back up to it with just as big of a move to the upside. IWM, you notice, again, it's right around its point of control. It's trading in between all of its moving averages are converging right on top of each other, right at the point of control. I showed you in Friday's video when that happened last time. That did lead to a breakout to the upside. Again, considering the mood of the markets now, you'd expect a breakdown to the downside. And as I mentioned before, the lack of volume below you, you can see all the way down to the pre-COVID highs. That would be very, very painful for a lot of people. And the Qs, you notice, as bearish as we are, well below the 50-day moving average. The 8 and 17 well below as well. I mean, we are in pullback mode. We are getting to the 200-day moving average, which is down here. That's why I think the Nasdaq still got to about probably 340 ish in this area by the time it's done with its decline. Again, ups and downs. If you take a look, obviously it had a 2% drop today. The Qs did. So a bigger move to the downside with a jump in volatility. So I expect that we'll probably get a move back up to the upside to get closer to the 8-day moving average before we get some more weakness. So I wouldn't be surprised if even as early as tomorrow we come back up, as bearish as today seemed. As early as tomorrow, we don't come right back up towards that 8-day moving average there, as far below as we are down there with as much volume and range. But keep in mind that now you've got that strong volume node above you, so it's not going to be very easy to get through either the 8 or the 17-day to get things turned around. Finally, let's take a look at volatility. And this is kind of an interesting chart because volatility jumped today but didn't spike, and we didn't even get up to the previous highs on an absolute basis or on a relative basis. So it kind of goes to show that things aren't as crazy bearish as it seems. Like, volatility is not going crazy on one hand. I mean, we are above 20, we're at 23, but what it really tells you too, on the other hand, here, let's go back to the 2-line version here. I told you before, if you get above the 200 and stay above it, to the point now where now the 30-day moving average is really close to getting it. The 200-day, you can see, if I highlight it, you can see over to the right, that's pretty much right on the 20 line, which is that red line. We're almost, the 8 and the 17-day moving average is above the 200. Now the 30 is about to get there. So, as long as we stay above these lines for volatility's sake, that's obviously when we're in pullback mode. But if you look at VIX 3M, VIX 3M has just getting above its 200-day moving average. And it's, again, reflects that people are still kind of, they're pricing in tail risk. In this case, tail risk for time. Because they're buying up. We're still at 24. We're still pretty bullish too on this long-term volatility. There's still a lot of concern about long-term, bigger, like a big 3-month drop, and not just a big up and down move, which is what the VIX would be more reflecting there. And you can also see that as well in the skew, as I mentioned on Friday. The skew is not quite yet. Let's see the new highs and new lows. You can see. We're actually positive today, interestingly enough. If you go back to the 1-year chart, which again shows that today's not nearly as bearish as it appeared, because look, our new highs and new lows are up to 47. The moving average continues to drop though, and getting below 0 is pretty significant for this index when the 20-day moving average gets below 0. But look at your skew, still at 130. Again, we're not really done with these intermediate declines until your skew gets down below 125 to 120, 122.5 to 120, whether it's the COVID drop or the last real intermediate decline that we had. All the rest of these getting below 135 are kind of mini pullbacks on the S&P, which is what the skew measures. So you can see there's still a lot of demand for tail risk. The demand hasn't dropped off enough to where we feel like we've experienced the tail risk, and there's not as much demand for it anymore. So what do you think? Do you agree with that assessment? Do you disagree? So again, my expectations is we're not done. I think we can bounce back up towards the 8-day moving average on some of these indexes tomorrow. I don't think it was that big of a deal today, as you'll see when we look at some more charts and what's driving the action today. Pretty well contained within a certain segment of the market. Not widespread, so not typical of actual intermediate declines. So we're still not quite like full-on breakdown mode that we've seen really in just other intermediate pullbacks. When I say breakdown mode, I mean to the point where we're retracing 38% of the previous rally. In fact, we're just barely retracing more than 23% of the Nasdaq's big long run. But that's the context we're in. We're in the context of retracing an insanely large move to the upside. So what might just be a pitter-patter type drop might be uncomfortable on an absolute basis, but on a relative basis, the S&P still hasn't even pulled back, even close to its 23% level of that post-Halloween low. So it kind of puts in context just how bearish we really are, and how much more selling we could get before we actually get more of a kind of washout that will lead to a new bounce up and a new green tag, which is kind of what we're looking for, right, is eventually in this red tag to form with a 5% number in it, maybe even a 10% number in it, right, which we haven't had for a while. But if we were to get a new 10% tag to form here, then of course you can see the numbers that come off of that, and the green tags are pretty nice. So that's when we know we've washed out, and even just to get down to this 400 level, which is where I expect we'll get down to 4,000 on SPX. That would create that 10% tag that I think would eventually lead us up to, in a long term, a new nice high. Not 100%. We won't get 100. I don't even think we'd get 44%, but I think we'd get more kind of in that 19, 20, that normal kind of runs once we wash out some of this crazy up and down that we've been getting over the last couple of years. Do you agree with that? Do you disagree? Let me know in the comment section, especially if you disagree. Let me know what charts or indicators you're looking at that would have you be either a lot more bullish than I am or a lot more bearish than I am. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. Quick way to give us feedback on what you're thinking about our stuff. Also, comment what did you get out of the video tonight? What stood out to you? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle there at DavidSettle42. And join our Market Outlook Facebook group that we've created, if it comes back up today. If you're watching us here on our blog, come over here and click on the Market Outlook Live icon right here. You can also get to it up in the Market Outlook menu, Market Outlook Live Trade Review. That brings you to this page. You can review and watch today's Market Outlook Live. In this video, we review all the current positions that we're in from previous Market Outlook trades that we've done in other videos to see whether we should stay in them or get out of them. We also put on today's trade idea that you'll hear at the end of this video. We've already put it on today. We put it on at the end of the, at the end of the market at 3:30 Eastern time. You can see all the old ones. We've got hundreds of old Market Outlook live archives here. Also, if you come over here on the right, here's our upcoming classes. If you click on View More or hit Trading Rooms, it takes you to this page. You can see all of our upcoming classes and all the prior recordings going back 3 years. Also, if you hit this, this heart icon right there, it opens up this new tab. Hit that like button, click on that thumbs up icon, brings you to your Facebook page. Click that like button. Again, the more you do that, it helps us get our content out to all of our followers. We obviously have a lot more than 15 people that follow us on Facebook, but the way Twitter and Facebook algorithms work, they promote content to their followers of a page or account based on how much engagement it has. So we try to, that's why we always ask for you, and also helps you too, because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, now let's take a look at what's driving this price action. So let me come down here to just today alone. You can see the big jump. You can obviously tell what's moving today just from that chart there. This is the 3-month chart. Obviously, you can see emerging markets going in one direction, commodities going in the other. You can see the Qs were the biggest losers today. Of course, Facebook having a big impact on that with news out over the weekend, and then coincidentally an outage here today. You can also see too the emerging markets lagging behind a little bit behind the S&P 500. Pretty much all equity asset classes down. Commodities, however, were up with weakness in the dollar. Long-term bonds were down, so yields were up. Real estate outperforming as well. Equities and gold was up. So this was your typical inflation trade, and kind of the inflation in a bad way trade, because it pushed risk appetite down to the downside. High yield, not underperforming too much, but underperforming bonds and long-term treasuries as well as global bonds there. So risk was off today. In this case, your QQQ lagging behind IWM, which is a little bit different than your risk-off trade that we had seen in prior months, but seems to be the risk-off mode right now as more and more of those stocks are coming down. We always look at the dollar, and that's a big driver for what's kind of going on here, and you can see we're rallying back up. But again, we don't get too wrapped up in this, right? The near-term line's up, but it always goes up. You can see every time it goes down, it goes back up. So that's what we're doing. The question is, will it go up high enough, right? Can we get above 90? You can see even that doesn't guarantee it. Now, it helps. In this case, that's about as close to a bullish move. I mean, we got dark green shading and a green line, so it helps to get it above 90. But just getting it above 60 doesn't do anything. And even just getting it above 80 without a strong move, that doesn't do anything either. So all that is, and hopefully you're learning more and more as you watch these videos day after day, but all it is when you extend away from the 8-day moving average, you come back up to it. And maybe even a little to the 17-day moving average like we did there before you extend back to the downside if we were going to maintain the bearish trend. So really important to kind of see how this near-term run, I mean, we are definitely in death cross environment. The 50-day moving average is still easily below the 200. The 30-day moving average is still easily below the 50. So we haven't changed the trend yet. At some point in time we will, and this very well could be a divergence. It's not really much of a divergent low point. Let's see if it is on the weekly. On this daily chart here, it's a lot of periods. It kind of is a little bit on the on the stochastics here, going into this would be the 200 week moving average, right there, right about that 50% retracement level. Let's take a look at what the RSI and the CCI look like as well. Going into this again, not very much of it's a really pretty significantly low RSI. It usually doesn't get that low, as you can see. Historically, it's pretty hard to get too extreme, and we got, that's about as extreme as we got there. But just outside of these really big moves, you notice this is about as low as we get, and it typically sparks some pretty good rallies coming off of that. So not much of a divergence from this low, but if I were to go to the weekly chart, that might be a little different. You can see actually we're not a divergence, but it definitely is a low point. Like getting below minus 200 on the weekly is pretty significant. Getting below 40 on the RSI in the weekly is pretty significant. So we either kind of continue this, or this is it. Like we're kind of setting the low point. I still think there's a pretty decent chance we come down towards this 1375 area by the time all is said and done. Here on that daily chart again, that sets us up towards. If you look at it here on this chart, sets us up towards, here, let me go out to a 2-year, down into this area, that old trend line. And it kind of sets you up also for this head and shoulders pattern that we had, this 1, 2, 3 triple top that are a little uneven. That's what head and shoulders are. And then you can see the breakdown below the neckline, the retest of the neckline before coming back down. The shaded area kind of gives you a target for this. It actually needs to be moved up a little bit, but it kind of gives you a target area. So that's why I think 1375, maybe a little bit below it down to the trend line by the time we get there, is more of the probability for where that's headed. Here's long-term bonds. Long-term bonds had dipped below the 200-day moving average. They're obviously well below the 8. So now the question is, they had just formed a golden cross, but they pulled back and retested the 200-day post golden cross. Are we going to get back up and get back? And there's a pretty strong resistance there. We'd have to get above that volume node to kind of really get going. And I still think that we're actually going to make it up towards this area, 157 more likely, if not all the way up to 163. I think more likely up to about 157 by the time this golden cross move is done. I think we're going to this is a test of the 200-day moving average, and I think we'll start to rally back up off of that. Gold prices, you can see, have hit the support, a big support. You can see how we got back above the 17-day moving average. We hold that, then there's a good change in trend back. We can start looking for it to get back above the 30 and the 50 and potentially reverse this death cross that gold is in. So you can see, like, in terms of safety, like, the safety trade is hardly overbought. In fact, you can be argued that the safety trade is actually still pretty oversold. So if we're like, okay, equities are really oversold, then safety trade should be overbought. But that's not the case. In fact, it's actually just as oversold. Right? In fact, that probably is more oversold than equities are. Because you remember, I know like recency bias makes us compare, equity returns to that green box. But you can't compare where we are now to that green box. You have to compare where we are now to the previous one, right? So if you were to go back even to this 19 box right there, if even with this little rally that we get here, up until where we're at right now, at this level, we're still nearly 20% higher than that peak, that parabolic peak that we hit. When did we hit that? Right at the very beginning of September. That sparked the only intermediate pullback the S&P's had since March. But that was a parabolic peak. We really kind of went up. And that sparked that pullback there that eventually culminated with a big jump in volatility right about at Halloween. And then we rallied. We're 20% above that high point. Like, we're 38% off of the Halloween low, but we're 20% off that. That's a really good move, even with the 5% pullback. So, we're hardly like, you wonder why. Well, why is safety trade so oversold still when stocks have been selling off? Because stocks haven't been selling off. This is hardly that much of a rotation into equities, or from equities into long-term bonds. When you look at this chart, you can kind of see like commodities are obviously pretty strong right now, and real estate has been strong, has lost some momentum. But if you look at like gold and the dollar and government treasuries and other corporate bonds, they're all lagging. They're all below 100. So they're either improving or they're lagging. And you have, U.S. equities, total market equities. That's this yellow box right there. These two commodities, and then real estate. They're all still. And then if you were to add on international equities, a kind of a total market international equities here, you can see that they're all still pretty strong. International equities have been lagging behind too, but there's your safety trade. This is on a weekly chart. They're not they're not way over here to the top right in terms of they've really been outperforming during this decline. So yes, and you wonder why. Why are they not so bullish when stocks have been pulling back so much? Well, because again, 5%, and if you look at it from this perspective in terms of 10% close to close pullbacks, we haven't had a 10% drop from since the March COVID low point. We've gone 102% with that one, and from the pre-COVID high, from that so not from this green peak, which we're down 5%, but from that green box, excuse me. If you look at that one, the pre-COVID highs, we're still over 26%, almost 27% higher than the pre-COVID highs, which were pretty darn bullish to get to those points. So it's hardly again, it's very recency bias, and it's very to have set figures like 5 or 10%, giving you the amount of correction or pullback that is there's no standards, right? It's all relative. It's relative to what's in these green boxes, and it's not you can't compare yourself to where you're coming down from. You have to compare yourself to the prior high, because you expect higher highs, you expect higher lows, you expect red boxes. That's been the nature of the beast. There's always red boxes, there's always green boxes, and so you expect there will be a next red. We can't go without a red box. That would be a 10% number in this case. So we expect to get one. We expect it to be higher than the last one. We expect it to be higher than the last green box. When we get one, we'll get a new green box with a new number in it, higher than this 102.78. So that's how it works. And so that's why I don't think we're necessarily done. And that's why the VIX isn't as extreme either, where it's at right now, because we're not this as crazy as this seems, as bearish as it has seemed. We are not very bearish. In fact, when you go out and kind of look longer term on this, look at our VIX. This is where we're at. That was kind of a little intraday peak, but really we never did get above 100, as you saw in the intraday chart. So it's kind of a misnomer, misprint there. We've been down below here. Look at all these other, look at that intermediate pullback in October, the Halloween low point. Look at the COVID low. Look at these two intermediate pullbacks that we had in 19. Look at the two market sentiment pullbacks. Look at where volatility got to. Look at where we're at right now. Again, we're right here where my cursor is on a relative basis. We haven't gotten to these levels yet. And so, even the volatility market's telling you, don't get worked up about it. Don't think that this is it. Don't think the low is in or the bottom is in, because, we're still not to the point where, risk is sold off and safety is overbought. And that's usually the case when the bottom has been set and when the bottom is in. So here's our sector 12 grid, and you can see dark pink shading, green lines across the board. And remember, energy is the only one energy had a great day today. It's the only one that's kind of the outlier, and financials didn't have it's been the other good sector and discretionary, and they both had some pretty down days. So we are now in the mode of everything is falling, and that is intermediate pullback mode. And especially once energy starts to join the party, you'll see that Russell 2000 its financials and energy have been helping the Russell 2000 kind of hold up a little bit here. Here's the major economy, global economies. You can see dark pink shading and red lines across the board too. You can see Japan's joining the party. India and Russia are the two outliers still. Everybody else, dark pink shading and a red line. So, this is more of a broad-based risk-off move than we've seen in a very, very long time. And we are obviously not nearly to any kind of extreme at all in sentiment. And so don't be surprised if we get more ups and downs, with the downs bigger and more frequent than the ups, and until we find some more support down to the low point. That's That's kind of my expectation, what I'm seeing even on what's driving the action here. All right, so for our trade idea of the day, I do want to remind you that, again, we've already put the trade idea on in the Market Outlook live video that you can get to here, as well as in the Market Outlook menu under live trade review. So for today's trade idea, we did look at Square. So let me pull up Square. You can see it's got a bearish dark pink shading and a red line. Bearish trend, the sentiment's down, the market sentiment line's actually dropping out of bullish territory, is back into neutral, making its way to the downside, so it could be down here for a bit. If you take a look at, its long-term chart, you can see bearish Hakinyashi candles, a falling PPL. It's still positive, but you notice we're right about at the 200-day moving average, the 40-week exponential moving average, excuse me. If you look at the daily versions of those lines, you can see that we're just barely below the 200, and the 8 and the 17 are falling below it too, and we've been down below the 200 before, just recently in May. So in this case, we're right around this big volume node that's got the point of control for the whole year, right about where we're at. So it's hard, it's going to be hard for this to go down too far. Like, we've got some supports set up here where all the volume is, but we also have, it's going to be hard for it to get going to the upside too, because you can see the the orange line here, the 50-day moving average, the 30-day has crossed below that, so we are going to be in this kind of pullback mode for a while. So but it looks like we can very well center around this big conglomeration of volume. That's pretty much where almost a whole year's worth, there's a little bit right there, from last October and early November. The rest of it's all right here. And if you take a look at like Ichimoku trend cloud, it's just barely turning negative. As bad as that is, you see we're just weakly bearish after being very noisy here. That just goes to show how bullish that we were previously. The DMI looks pretty extreme. The negative indicator got up above 40. That's a pretty extreme level. We saw that over here, and that kind of set the low point for the channel before. When you look at the RSI and the CCI, they also hit some extremes, down to 30 on the RSI, and looking like setting up some divergent low points on the CCI. If you look at the, let's see, we looked at this one. I wanted to look at the linear regression. So you can see the S&P 500 is at the 2 standard deviations of its a 1-year linear regression. This is Square. You can see that it's at the 1 standard deviation away from its 1-year linear regression as well. If I were to go out 5 years, you can see that it's as low as it can go. That's when you'll get to that kind of 5-year trend line, the best fit trend line that we're at. So and that's where those lows are. So there's going to be some pretty decent support right around 200 at that point. So and also some resistance up here at the top too, because of where the previous highs are, and pretty much the nature of the market. So what we decided to do was to sell a call spread on the upside at 260, 270, sell a put spread on the downside, so sell a 200, buy the 195, do 2 of those so I can keep the wings here equal, balanced. And you can see again, very much like Etsy on Friday, we get a normal reward for 2/3 of a normal risk because of the earnings it has, as well as the kind of volatility that it has too. And you notice, and because of the volatility, that we got some really wide break even. So we've got a lot of room this thing can go up and down in. And you notice pretty much the entire value area is all inside of, and the point of control is right smack dab in the middle of my 2 break even. So I really like how that risk profile is set up, especially getting a normal reward for a lot less risk than normal. So that's why we're going to put that on for today's trade idea. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new threads there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.